Hey, we are live. We are live. Welcome, everyone. Welcome to Carolina Retirement Planners Happy Half Hour. Those of you probably know I'm David Shakavage. I am the president of Carolina Retirement Planners. And usually my daughter and partner, Sam, is here, but she's off at a conference. So we have a very special guest today. We have Daniel Wildermuth, and he is here to talk about some of the ways the big boys do it. I don't know if you ever heard about this, but some of the best investors in the country are known to be places like Yale and Harvard. They've got endowments where they have billions of dollars, and the guys that are running these endowments are the smartest folks going, and they have done very well in terms of performance. And they've used a set of strategies that are different than perhaps we're accustomed to. And we're going to talk about that. Daniel is an expert on that. In fact, he wrote the book on it, Wise Money, and you'll have a chance to win a couple copies of this here in a little bit. But as always, we like to start a little lighthearted. Amy, are you there? Amy's here somewhere.
I am. Hi.
Here's Amy. Wow. Amy, what day is today?
Today is a day that is near and dear to my heart. Today is National Vinyl Record Day, and I collect records. It is something that I absolutely love. So, and I brought some to share.
You brought some to share. What kind of records did you bring?
So
this is going to be good.
Okay, it is going to be good. So I brought one that is so worn out, it is actually taped together. This here is, if anybody can read it, is Tiny Tim. I don't know if anybody even knows who that is.
Tiptoe through the tulips.
Yes,
that's right.
Yeah. Yes. And 2 times a day, I always brush my teeth. So this, I played over and over, and my mom actually had to tape it together because it is so worn out.
If you've got a Tiny Tim album at home, be sure to tell us in the chat.
I mean, who has that? I do. It's ridiculous. And then another one that I just pulled from my collection of just nonsense is this album here. It's a Greenpeace album. But the best part about it is that I acquired it when I was in Russia many, many years ago. It was like in the late 80s. And the only part that is in English is Greenpeace Breakthrough. Everything else, and I'll see if you can see it, is in Russian. So, yeah, I don't really.
And they got a whole different alphabet.
Yeah. I mean, they have more letters than we do. So it would take me forever to translate that. I don't even know.
There's 2 other people that are on with us. I want to bring them on and introduce them.
Say hi.
If Kristen and Mark, if you could turn your video on for a second.
Off while they say hi, so I can put the hellos in for everybody.
You probably can tell the difference between Mark and Kristen. Mark works with Daniel, and he's joined us today. He is in South Carolina. Daniel's in Florida. Kristen, for those of you who may not have met her, she is now sitting in her office. She is taken over for Susan as our director of first impressions. And with Sam gone, she is in charge of doing the drawing today. So she is a very important person.
Ooh, yes,
big job.
Very excited.
So this should be good. And I see that we have Diane has joined us to say hi, and Miranda, once again, good to see you. Brad, another regular. Bruce, Kim, Dan, and Barb, probably there enjoying gin and tonics up in the mountains. Bruce says they drove by Uwharrie National Forest yesterday coming back from Ohio. They waved in my cabin. I wish I could have been there. And I see Rick's here, probably with Marcy. I have about 5 feet of vinyl albums. I was one of the founding members of the local public radio station, WHQR. And I had a folk show for years and years. And everywhere I go to used record stores, like Boston's the Mecca, you go through and you look at all these used folk albums. And I specialize too in collecting Bob Wills and the Texas Playboys and the Clancy Brothers. So I got a especially big collection for St. Patrick's Day. Man, I'm in, So that's kind of my relationship with albums. But you have any favorite albums, Daniel?
It was pretty traditional. I like Boston and Styx and Foreigner, something, nothing too adventuresome, but I love my vinyl. It's difficult to give it up. I probably shouldn't have, but don't have it anymore. I never had 5 feet though of albums. I had like 1.5 feet, I think, or something like that.
Yeah, it gets out of hand after a while. And I hate to throw them away because they're,
Never throw them away. Never, ever. No, 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 no. Don't do that. Don't.
I was
Well, I've
I
been
was at least
thinking-
able to donate mine to a local record store.
Yes, there you go. I like to donate, give them away, sell them. Don't throw them away. I would cry.
I'd like to get a good a system where I could digitize them, because a lot of them never made it to digital, and it'd be nice to record some in so I could play them on wherever I wanted, but that's a hoot. But well, Daniel, I'm gonna bring up a little bit here on the share kind of a screen with a little presentation that you have. Tell us about there we go. Tell us about our topic today. This is a fascinating topic. This is sort of the inside scoop on how the big boys do it. And I'm just so glad I met Daniel and Mark a few weeks ago at a conference, and we are able to use some of their things as of June. And so I thought, boy, it'd be great to have him come on a happy half hour. So why don't you tell us more about Wildermuth Endowment Fund and investing and all, and how these big guys, how the principles do these big guys do it?
The biggest thing they do that's different is they invest in different securities than most individuals do. So they tend to take advantage of private markets. So they're investing in private companies, private real estate, other things that do not trade in public markets, as opposed to most of us who have a lot of our money in public stocks or bonds or something along those lines. They have the minority of their assets in those areas. So that's the biggest difference. It's fairly straightforward. It's just hard for most individuals to do that. But that's that's really simple. That's what the difference is.
So they're buying things that the average Joe can't just go to Fidelity and get.
Yep, that's very simply how it works.
And I like this. One of the things that have become popular is SPACs, which, near as I can tell, is where you give people money to invest in something and you don't know what it is yet.
Yep.
So here's a blank check, or here's so many dollars, please invest it for me. I don't care what, I trust you.
Yeah, they did great last year. They've done terrible this year, but that's kind of the way it goes.
Well, there's apparently so much money chasing, so much capital out there looking to be invested.
Yeah.
I think I read that. Well, this last 6 months have been the best 6 months for venture capital ever. But
yeah, it's been a good time for that sector. They're raising assets have been going up, so it's been a good time period.
Okay. Let me know if I'm going too fast too. You can pace me.
No, you can just move through them. I'll add comments. So go ahead.
Well, like we said here, things are, people always ask, is the market high? People, how do you know when the market is high? And this is sort of one of my favorite explanations that you put here. If you look down here, if you bought a stock simplistically for $10 and it paid you $1 a year in dividends, you would have a price to earnings ratio of 10, right?
Mm-hmm.
And the average price to earnings ratio over the last 25 years is about 17. And right now we're up here at what? Like 20, 21, 22. Looks a lot like it was back in the dot-com crash.
Yep.
So,
the only time it's been higher than it is today, or as high as it is today, was in 1929. So it's 1929, 1999, and 2021. Not
yeah,
the best company. Yeah.
And I know there wasn't that many of our listeners around in 29, but you've seen the black and white movies,
Yeah.
So,
Yeah,
so
and a 25-year average is high as well. It was lower. If you go back 50 years, it goes down to about 14. So that's a high average as well. Yeah.
yeah, so there's a
I'm a fan of
reason.
black and white movies. Can I just say that? I might not have been around that long ago, but I still like those movies. I really do.
Yeah, yeah. Those soup kitchens, but so it's like, where do you go now that with things potentially overvalued?
Yeah, and that's with equities as well. If you look at the Cape-Shiller PE ratio, which takes an average of 10 years of earnings, it's also at record highs as well. So kind of by every measure, equity markets are quite expensive today. And transition to fixed income, and I think everybody knows at this point that current yields are extremely low. So fixed income is kind of it's just difficult to make any money in it. In many cases, the real yield is now negative. So if you look at what the actual yield is, at around 1.5%, it's negative. If you count for inflation. So tips or those types of things are all paying negative returns. So it's kind of tough to make any money in fixed income. So you look at the combination of equities and fixed incomes are not particularly attractive in today's markets. So
Yeah, and with bonds as well, if interest rates go up,
yeah,
bonds are going to. We talked about that a few weeks ago.
yeah.
Are my bonds safe? So it's tough to figure out what to do out there.
You've got even some of the junk bonds, which are the bonds that tend to pay more because you're taking more risk. Some of those on an inflation basis are now actually paying negative returns as well. So the credit quality has gone down. There's just a lot of problems with fixed income today.
So this is a different way to skin the cat.
Very much so.
I remember this guy. I remember hearing about him years ago.
Yep. Yeah, he just passed away, but he made quite a name for himself during his career. He took over at Yale in 1985. And when he took over, 90% of their assets were in stocks and bonds. So they looked like a typical person's portfolio today. And he immediately came in and started changing that, though. So he went out and targeted private markets, particularly private equity, private real estate, and other areas that did not publicly trade. So his results were incredibly strong while he was there. He managed to grow their endowment from about $2 billion to around $24 billion today. So it's been an incredible expansion. And then his model was so well accepted and so widely copied by everybody that today any endowment with more than $1 billion follows the same model or some version of it. The endowment model is not as simple as, say, a 60-40 stock bond model. It's got more asset classes in it, so you can have more different models in it. But pretty much everybody follows this pattern of investing into private securities.
In fact, I think, there Yale. This is an interesting place. Most folks realize that at least what's left of pension funds have an awful lot of money there. They got really smart people to manage it, and they've also moved to this model as a way to get away from the regular rat race and manage with what could be a better system. So it isn't just the big universities; it's actually the pension funds that also have a ton of money in them.
Yeah, it's pretty much all institutions have followed this, and pension funds have a little different model because they've got very specific needs that they have to fund every year, unlike endowments where they can actually cut back a little bit if they have a very poor year. But pension funds have followed a similar model as well. So they've really adopted investing into private securities. So.
Yeah, and so this graph looks a little complicated, but we're going to simplify it. This is Yale's mix of stuff this is from 1989, but we can go back. What did you say, 1985?
Right, 1985, there was none of the grade, none of the leveraged buyout or venture capital at the top. So there was none of that. And
so if you go back to 1985, this part here was stocks, U.S. and foreign stocks.
80%, yep.
And now there's only this much left.
Right. In fact, most people, if you kind of look at that chart on the right-hand side, you can see the domestic equity is just about 2%. And of course, that's what most people have a lot of their assets in. And then you got cash, Other stuff is about another, 7-8%. So they've got less than 10% of their assets in what most people have all of their assets in, at least a large percentage. So, and they've got a tremendously large amount of their assets, again, in private markets or other things that are certainly unique for them. So
Yeah.
that's,
So they expanded out. This whole part was created with his tenure there.
Yeah.
And he just basically got out of most of the stock market into other types of investments.
yeah, very much so.
Yeah, just boy, it's interesting to see how, because I've always read about these folks, but it's been the sort of their secret sauce,
Yeah, and here's a different way of looking at it. So it's kind of the same graph a little bit differently, but there you see domestic equity at just over 2%. And the private equity, which is just private companies, and private equity venture capital, which is a smaller version of the private companies. So that's over 40% of it's 41% of their total allocation in that area. And then you have the other things making up the balance of it with natural resources and real estate. Natural resources can be oil and gas, and commodities to a lesser degree. Real estate, absolute return, those are hedged positions. So you possibly, you have stocks, but you have a hedge against it. So it doesn't necessarily have correlation with the stock market. And then you have kind of the cash and fixed income at 7.5%. So again, but most of that is in asset classes that the average person really struggles to gain access to. And those first charts, we're talking about Yale specifically, and you see their Yale on the bottom right-hand side. Yale had 78.5% of its assets in alternatives, and Harvard just trails closely behind it at 70%. But pretty much any endowment with any amount of money, meaning more than $1 billion, and that's basically all your larger universities, has an average about 60% of its assets in alternatives. And the larger the schools get, the higher that number grows to. So you see, a lot of your large universities are 70%, over 70%. That's very, very common, that they've got a tremendous amount of their assets in things outside of traded stocks and bonds today. Now that means that they may not have done as well over the last year, where the market has done incredibly well, but it means when you look at their average returns over time, it tends to be much greater than the stocks actually return, with a fraction of the volatility. So that's the big reason they do this, is because the returns are stronger and the volatility is far less. So that's been their kind of end results.
And they're really looking for stability and income, which is sort of a lot, same thing a lot of retirees are looking for too.
Yeah. So here you see the returns of the S&P 500 versus the Yale Endowment. Yale Endowment doubled the returns over that time period, over the 20 years. And part of it, their returns were about even over the last 10 years, but over the previous 10 years, they outperformed them tremendously. And we're probably heading into a period that was more similar to the first 10 years. So 2000 to 2010, when markets kind of went sideways. And I'm kind of guessing that, there's no guarantee, but with market valuations being as high as they are, we're looking more similar to what we looked like in 1999 than what we looked like in 2010, when valuations were very reasonable. We just have a lot more potential for headwind in front of us. And, this market could continue strong for, a year, 5 years. I think the odds are stacked against us having an ongoing return for a significant time period. So I think it looks much more likely to have headwinds going forward. And I think the endowment model makes much more sense for today's investor.
Now, we talked about different things that they're investing in: private equity, venture capital. You want to maybe give us a little more details as to what these things are, or the kind of
private equity
things?
and venture capital are both similar. Private equity is basically investing into private companies. So these are companies that are not trading on public markets. There's several advantages to investing directly into private companies. One is you're able to buy a given dollar of earnings, going back to that chart that you outlined for us earlier, Bob, or David. The price to a dollar of earnings in private equity markets is usually about 6 to 8. It can be 4 to 5, but you're able to buy the dollar of earnings there much, much less expensively. And venture capital, similar. Venture capital is basically just another version of private equity, private markets. And that's a huge advantage, because you can buy a smaller company And first of all, they're often growing much faster. They have much better growth potential. And then you can also sell it out to a larger company and they'll pay 10 to 15 times that, because their price to earnings ratio that's traded on the public market, they're trading with house money at that point. So they're trading with money that they're able to basically multiply by buying a company that's much less expensive than their earnings are actually being paid for. So it's a very opportunistic play for them. So it's a great market to play in. The biggest challenge for most people is gaining access to those markets. Most people don't go out and analyze private companies to buy them routinely. So that's most people's hesitance with going in the market. You can't just go out and buy it in the afternoon on Fidelity or whatever company, whatever trading firm you're at. So there's a lot more research that goes into it, but you tend to be well rewarded over time. Real assets, you can do those in different ways to sell, but those, real assets, a building, if you're playing in a building or sitting in a building now, that's an office building that may be owned by a public company, it may be more likely owned by a private company. So these are, real assets out there. A big advantage of this is that, there's only about 4,000 to 5,000 companies that trade in the market, and there's about 200,000 analysts that are looking at that daily. Versus private companies, there's many, many times more private companies. There's more like 200,000 private companies or more in the United States, and you've got a much smaller number of people looking at them. So the field is much, much wider and much more open. And I think it offers far more attractive opportunities in that space. And the big thing as well is you're able to add things into a portfolio or invest in ways that are far less expensive, and you're able to go in and introduce things into a portfolio at much more reasonable valuations than today's public markets offer. So you also get the benefits of having a much more diverse portfolio. It's just the risks are also much more driven by what's happening in the company, whereas public markets tend to have far more outside variables that play on them. You can have something comes out kind of anywhere and the markets go up or down, where these values don't tend to have those values driven by outside opportunities. They're much more driven by what's happening within the company. So you've got much less volatility generally with these companies than you do with public securities.
So a lot of opportunity on many fronts. You just got to work a little harder to find it and then obtain it.
Yeah. Yep. Much more opportunity, just harder to realize.
But if you want to do better, it takes work, right? So
yeah, it does. So that's why I have a job.
Anything here? I think
Yeah, your biggest, for most private markets, the biggest challenge for most people is access. And particularly if you're going to be, investing in the quality options you really want to be in, but access is hard for most people. There's a lot of other advantages to, I think, investing in different ways, but you have to have a fair amount of knowledge, and you have to have, just different ways to access. But most people, access is really a challenge for them. Got some other things too in terms of costs and that type of thing, and so that's you've got other things on the slide, but access is the biggest challenge for most people.
Yeah, it's like you say, where do you start and how do you do it?
Yeah.
But you've been doing this for some time. You've got actually, I think a couple strategies. A larger fund you run for a while, and then you brought that down to a more accessible level for the average, so-called the average Joe, the kind of folks that might be on this call. So I want to tell us what was your big fund? How big is it?
We have about $4 billion of assets kind of under management in a different categories. So that's worked well for us. This fund is it's newer, it's smaller, but it's still been running at it for about 6 years now, 6.5 years. And it's going well. The nice thing is that anybody can invest in it. You only have to have $2,500 to invest. Mm-hmm. So it's gone well for us, and we've got access to the same things that the large endowments do. We've got a much larger staff than a typical endowment would have at our size, because we're set up for this for the long term. We understand that this is something that the returns will pay off for us and will be rewarded down the road. We made a strong investment into making this work for us and have been so far fairly well rewarded. We're kind of number one in our asset, number one in alternative space from a performance standpoint, and also from a Sortino ratio, which is just simply a risk-adjusted performance measure. But that's gone very well for us, so we're very pleased with it to date. So that's kind of what the fund does. It's got a similar allocation to what Yale does, not surprisingly. We're not exactly the same as Yale, but nobody's going to be exactly the same, but similar allocation of large endowments, and it's working quite well.
Well, say I got excited when I met you a month or so ago. It's great to have other strategies besides this, like everybody's buying Apple and Google, and it's nice to know, it's nice to have other strategies that we can go in. Now, we don't like to go into a lot of salesy stuff on the happy half hour, so this isn't meant to say, oh, here's returns and all, from a compliance standpoint, here's some of the fine print that we got to put up here whenever we talk about stuff like this from a compliance standpoint. But if you would like to learn more, there's a couple of things you can do. You can always go to the website carolina15.com, and there you can book a 15-minute phone call with me to talk about this or anything else you want. But you say, tell me more about this. You can also just set up a more formal meeting. Amy, how can they get in touch with me with a more formal meeting?
They could actually call the office, but I've put both I put both the Carolina 15 in the comments and our phone number, and they can call Kristen. The office number is 910-815-3100. But all of our Facebook comments, they're there. They can go and they can get the information and schedule directly from there.
Yeah, because this is the first time I've seen something where, boy, you can get these strategies easily, on your own. So I'm excited. I'm excited. Well, let's say a few more highs while Kristen comes on and gets ready for the drawing. Where do we leave off?
Yeah, you had a bunch of people come in. So while she shakes up that, I don't know if she found the fishbowl. Oh, she got a cup. I didn't know. Everything is crazy. I like it.
Be a nice human mug.
Where do we there's Rick, Nadine, and Ed's here, and Cindy is here. She loves the Clancy brothers as well. Good taste.
I don't think anybody knew who my Tiny Tim record. Nobody.
I can't believe people tiptoe through the tulips.
Yeah, I even showed my piece together.
The little ukulele. Kim is here. Yes, 70s music. Martha, Brad, our index funds. Nancy King is here, and some lady named Teresa. How do you pronounce her middle name?
That's her maiden name, Maciejewski.
Yeah, there we go.
Another one of us Polish people. We're
good
taking over.
pierogi eater on here.
Oh, my mom, gotta love her.
Bruce, Cindy, and Hans. Good to see you, Hans. So, well, with that, let's see. We could probably do our drawing, and I want to thank Daniel and Mark for joining us. We don't have many guests very often, and I don't think I've ever had a financial guest. I've had attorneys and I've had concierge doctors, but we'll need to do more. If you like this, let us know if this was good and see if we should bring some more folks in. Maybe sometime we can bring Daniel back to talk about some of this in more detail. So,
certainly my pleasure. So David, thanks for inviting me. So it's a wonderful time.
Well, with a little drum roll, Kristen,
Are we ready?
we're ready.
Okay. Our wine winner of the week is Barb and Tom P.
Okay. Barb and Tom, congratulations.
Congratulations. We didn't even talk about what we were drinking today or do a cheers. So
No, we didn't. We had a lot to cover, though.
It's been a busy afternoon.
So
congratulations, Barb. And I got to write that down. Barb and
Tom.
Barb and Tom. Congratulations. Oh, they've been around entering for a long time. So that's good. Oh, yay. Wonderful.
Finally coming back around with the luck for them.
Good. I like to see that stuff. So we'll say cheers and Daniel, thank you
Yeah.
so much. We had a lot of people on, a lot of questions, and we appreciate it. So.
Yeah, Dan, and I'll give you a call in a second just to chat some more. With that, everybody, it's been great, and you have a great week. And we'll see you next Thursday for our next happy half hour.
Yes, thank you. Cheers, everyone. Have a wonderful weekend.
Cheers.
Bye.
Right.